You're listening to Batting 1000 with Dale Vermillion, where heavy hitters from mortgage, real estate, and business share their secrets for lasting success. With your host, award-winning sales strategist and industry icon, Dale Vermillion.
All right, hello everybody, and welcome to Batting 1000, where we talk to the heavy hitters in the mortgage arena. And today I'm wearing my Be a Humble Hero t-shirt for a reason, because I've got a guy who needs absolutely no introduction. He is one of the icons of the mortgage industry, a dear friend for almost 20 years now, a comrade, a partner, a guy that I love to death as a human being, and he is truly a humble hero. Today I get to hang out with Barry Habib, and it just doesn't get any better than this. Barry, we are so honored. I'm so honored to have you on the show. I'm so honored to kick off the season with you. I can't think of a better guest to have to kick off this 2022 broadcast of Batting 1000. Author of Money in the Streets. You've done it all. You've spoke all over the nation. Everybody knows who you are. Barry, so glad to have you.
I'm so honored to be here. It's certainly a privilege, and I love spending time with you, Dal, as you know, and obviously spending time with Jake too is just great. I could say all those exact same things right back towards you, my friend. Appreciate you and everything that you do.
Well, feeling so mutual. So, look, I know we've got an audience out there that's sitting in a changing, crazy market, and there's nobody that has a better understanding of what rates are doing, what the market's doing, where it's going, and I know you got a lot of great stuff to share today. So we'll just jump right in and let's talk about what's happening in today's mortgage market. Let's talk about what the prognosis is from your perspective on what rates are going to do in the rest of this 2022 year. What originators do. Let's talk about how we can help these guys today and the lenders that are out there to just be more successful. Barry, I'm going to let you kind of open that up and talk a little bit about what you're seeing out there and what some of the trends are and some of the things that you think are going to happen.
So we know that this is a market that's got a lot of moving parts, but once we understand it, a little spoiler alert here, I think long-term the news is good, but there are some different components. Very, very short-term, few months down the road, changes in both areas, and then longer-term and what that means. So the things I'd like to touch on is interest rates, of course. We know that the relationship is most important, and we know that being an advisor and choosing the right products are most important, but certainly interest rates will have a very big influence on what's going on. So we want to make sure we understand what's driving it, what the Fed's role is, and we can talk about those things. But I also want to make sure that people know what the driving force is behind these moves that we've been seeing in interest rates. And then what's its impact on the overall economy, on us, and of course the housing market, because we hear so much bad stuff on the housing market, and people have gotten it wrong, Del, for a long time. They've been blowing alarm whistles on housing. And as you know, we've been pretty steadfast in forecasting housing. I think we've done a very good job of that. And I think right now, probably as loud as the drumbeat as I can remember, people are forecasting a big crash, although they've been forecasting this for 7 years now. But the drumbeat's getting louder and louder and louder. And I think they just misinterpret a lot of the data. So I have ways for us to understand that.
Good. Let me ask you this question as we lead into this, because one of the things, Barry, that I have been just preaching like crazy across the nation in all the sessions that I do. You and I speak a lot at conferences and with lenders and with brokers across the country and loan officers. And look, the one thing I keep telling people is, first off, this is an incredibly opportunistic market if you approach it the right way. This is where you can win market share if you're doing it the right way. The key is you got to change. In a challenging market, if you think about the word challenge, it's got the word change embedded in it. It literally, CHALLENGE, change is at the beginning and end of challenge. And what I'm telling people is you got to have confidence in your ability to be able to help people in this market. You got to remember, the American dream is still the American dream. Rates go up, people are still going to buy homes, especially with the massive demand that is out there because of the population numbers that we see today. And on the refi side, there's still refi opportunities if you're leveraging debt and doing the right things. Would you agree that this is an incredibly opportunistic market for those who are out there today if they learn to modify their behavior from 2021, change the market? And you said something really key a minute ago. really focus in on relationships. Slow yourself down, spend more time with your customers and with your referral partners and the people you work with, and really just do it right. Would you agree with
Of
that?
course, yeah. I think you said so many important things there, and the opportunity that exists right now is one where you can really grow market share. But we do have to change, just as you said, some of the things we're
Yep.
doing. It's been a different market for the past 2.5 years, and people have gotten accustomed to that.
Yep.
It was an easier market, let's put it that way. But
Yep.
this is, easy times make soft people. More difficult times make stronger people. And
Yep. Right.
that's what we are going to be faced with here. But it's not going to last long. I think that all the loans we're doing today are going to be refinanced in the not too distant future, certainly within the next 12 months. That's what the market's telling you. That's why I can't get a 0 point quote. People mistakenly call that a par rate. It's not par. Par means the loan will be sold and bought for the value of the loan. So a $500,000 loan will be bought for $500,000. You can't do that and offer the customer zero. The nomenclature has gotten screwed up and people just have made mistakes and carried that through. Par rate means that a $500,000 loan will be bought for $500,000. So in order to make money, the customer has to pay 2 or 3 points on that thing. So if you're going to
Right.
do a loan where the customer's at zero, somebody's paying $510,000, $515,000 for that loan. So the originator, the originating company, the servicer, the agencies, and the securitizer on Wall Street can all get paid out of that money. So the
Yep.
investor, before they spend $515,000 for a loan that's worth 500, needs to be incented to do so. And the way that they're incented is with additional yield. Now, normal circumstances, that yield would typically be in the range of, if you wanted to go for a loan that was, let's just say a 0 point loan as opposed to a 1 point loan or a 2 point loan, the difference would be 1/4% or 1/2% more in yield, about 1/4% for each point that you would be able to get in premium. Well, nobody wants that because they don't think the loan's going to be on the books that long. So I'm not going to spend $510,000 or $515,000 to get a little bit more in interest when I know that loan might refinance in 6 months, 8 months, 15 months, whatever it is, because I believe
Right.
that the market's coming down. So in a crazy, perverse way, this difficulty that people are having is the market, the smart money, saying these rates are not going to be up here for very long, and they're going to come back down. So nobody wants to be left holding the bag. So what do? If you want a 0 point quote, we're going to make it really painful, they say, for you to do that to kind of dissuade you from it. So instead of it being a 1/4 point in rate gets you 1 point back, you got to go a full point in rate to get 1 point back. It's almost ridiculous to do so, but that's the way that the buyers are looking at this market and saying that these rates will not remain here very long.
So tell us the forecast. What do you see happening out there, Barry? What do you see the future hold? What are some great strategies and ideas that you can share with the audience today in today's marketplace to build confidence, to build encouragement, to get people thinking again that this is a great industry to be in?
Well, it is a great industry to be in, and the fact that other people may not change the way they're thinking. You remember Albert Einstein said the same thought process, the same way of thinking that got us into this is not the way we're going to solve this, right? That's from Albert Einstein, pretty bright guy. So we have to change the way we think. We clearly have to take more of an advisory approach, and we have to solve the problems that are in existence today. So if I can, Dale, I want to maybe go through some slides and kind of talk to everybody a little bit here first and explain what's going on, why, where we're going, and I'll give you the triggers to see and also some solutions. So first of all,
Great.
let's take a look at what is driving interest rates. And it's the crazy thing about this is that people in this industry, Dale, don't understand what even drives interest rates. You would think we're in the business where, I wrote loans for over 20 years. I never had a customer say, the box there, it says interest rate, you fill in whatever you feel like. Everybody's going to ask you, where are rates going? What do you think? What's the current environment? And the way we answer that question is really important. That's an opportunity to show how bright you are. Because the person who says, well, if I knew the answer to that, I'd be on vacation somewhere having a pina colada. Well, that might be funny, but you just blew an opportunity because now you sound like everyone else, and you just said, I have no clue what the frick's going on. What you really need to do is to be able to understand it. So let's understand, first of all, what drives mortgage rates. It's not the Fed. The Fed has influence, but not in the ways you might think. It's inflation. So mortgages are long-term mortgage rates. So you got to turn your hat around right now, and instead of looking at it through the eyes of a borrower or a mortgage originator, look through the eyes of someone investing in that mortgage and buying that mortgage. Look through those lenses. And when you do, what you see is that, okay, I just gave you, just pick some numbers here, a $400,000 mortgage, and I'm getting $2,000 a month in monthly payment. Just some round numbers, right? So now that $2,000 a month, I take it and I buy a list of goods and services. This month, I get the check. Next month, I do the same thing the month after, maybe. But over time, I can't get everything on my list. I have to leave a few things off because inflation makes things cost more, and therefore I can't get everything I used to. Literally, my buying power is eroding. So the check says $2,000, but I don't buy what $2,000 used to buy. When inflation is very low, I can offer a low rate of interest because that erosion happens very slowly. But now inflation has gone on a year-over-year basis from less than 1.5% to currently 8.6% as measured by the Consumer Price Index. That changes the game. And that's why rates have gone up, because I can't do anything about the loans I've given in the past. What I can do, though, is on new loans, I can try to account for that more rapid rate of erosion because of higher inflation in my buying power. So what do? On that same $400,000 loan, I can't start at $2,000. I got to start at $2,200, $2,300, $2,400, $2,500 to offset the more rapid rate of erosion that I'm experiencing every month. So that's why you're seeing mortgage rates rise. And in fact, Dale, I could show you kind of a pretty cool chart that really kind of speaks to this in a good way. And so let's take a look at some of the charts that I have here, Dale. I'm going to share my screen. If that's okay with you.
Yeah, absolutely.
And let's do it. And Dale, you tell me if you could see that screen, it looks good to you.
Looks good.
So we got a lot of the R word now, recession. And, Dale, I'm very proud. You and I have talked about this. I remember when I called the recession for 2020, in 2019, everybody thought I was nuts. And sure enough, it happened in January of 2020. And we have been calling, believe it or not, since 11 months ago. It's on MBS Highway. It's documented. We made the call for second half of 2022. Looks like a recession to us. Again, everybody thought we were nuts. But the methodology is proving out that it's going to more than likely be very accurate. So, Dale, right now people are looking at the market and they're saying, hey, it feels a lot worse. The MBA estimated 2.6 trillion in originations. I think it'll come in less than that. But let's just say it comes in 2.3. That would be like the third best year in the last 16 years in volume. So there's volume out there. We just got to get our share. And purchases, for all the hand rigging and all the crap that you hear on TV, purchases, when you compare them to the last decade, they're at a very strong level. Now, we had this big dip because of COVID. This here, a lot of that is makeup for the big dip. So we're coming off of very high levels. Now, when you say, okay, let's compare it to the previous year, it looks like purchases are going down. But if you take the noise out of COVID and the crazy influence that the Fed had, and the QE, and you say, let's compare it to 2019, 2018, 2017, 2017, it compares very favorably. This is a very good market. So don't believe the crap in the media. Now, remember I told you that inflation drives mortgage rates, and here's the proof. Let's take a peek over the past 50 years and watch what happens. The white line's inflation. So inflation starts to move up first, and then what are mortgage rates in blue? What do? There's a lag, but after inflation moves up, then mortgage rates move up. Inflation starts coming down, again, there's a lag. Actually, mortgage rates went up a little bit longer, but then once inflation was coming down, mortgage rates came down. It's the same pattern over and over and over with just a little bit of a lag for mortgage rates, and here we are now. Inflation shoots up, and mortgage rates are simply following suit. So if you want to know where are we going to be with interest rates, we have to watch inflation. When will inflation come down? And the answer is right here. This is an important inflation measurement. It's called the Consumer Price Index, or CPI. When we take a look at CPI, it's made up of the most recent 12 months. The most recent data we got was a couple of weeks ago for the month of May of 2022, right here. It was 1% for that 1 month. If you go from May of 2022 to June of 2021, you add these up with a little bit of rounding, with a little bit of compounding, and that gives you your 8.6% year-over-year inflation. Now, the reason why the market performed so badly and rates jumped up after the last inflation report, and the reason why the Fed said, oh my gosh, we better hike at a greater rate, is because this number for May came in at 1%. It replaced the May 2021 number, which was 0.7, which made the year-over-year number go up by the same 0.3. It went from 8.3 year-over-year to 8.6, and the market panicked. Now, in a couple of weeks from now, Dale, we're going to get the number for June of 2022. I think it's quite possible that the number for June of 2022 comes in less than the number it will replace. Maybe it comes in 6 or 0.7, and the inflation number year over year should go down from 8.6 to maybe 8.4, 8.3, something like that. And everybody's going to say, oh my gosh, pop the champagne corks, inflation has peaked. So I think mortgage bonds will respond well. But here's what nobody's counting on. They're not looking at this. And what we see here was the inflation readings for 2021 were quite low, which means it won't take much when we get the numbers to replace July, August, and September for the new readings to be higher, which tells us inflation will have a resurgence over the summer and early fall, and mortgage rates, we could get a little bit of a break here in lower rates for the next month or so, but after that, it's going to be a little bit more challenging summer. Now, I believe, Dale, that when we get into the fall, we get into the fourth quarter and the first quarter of next year, you could see the comparisons are much higher. Because of that alone, inflation should drop. Plus, the Fed rate hikes will start to take hold. So if we think about inflation drives mortgage rates. So what is inflation? The definition of inflation is too many dollars chasing too few goods. So one of the things that's out there is supply chain is now alleviating. Shanghai was all bottled up, and that is an enormous port, largest in the world. We start to get goods flow by the fourth quarter. That alleviates some of those concerns on the inflation front from supply. But also what the Fed's trying to do by hiking rates is demand destruction. Now, the Fed does not control long-term rates. The Fed controls short-term rates, which affects home equity loans, car loans, credit cards, personal loans, but the big one are the commercial loans. That's the one that's there based on the Fed funds rate plus a little bit of a margin, but that's your $300 million, $500 million loan. Should I build this factory? Should I do this expansion? Blah, blah, blah. All that stuff slows down because the economics of it, I should say, doesn't make sense at the higher cost. Plus, remember, inflation is too many dollars chasing too few goods. So that lack of or less borrowing money because its rates are higher will slow down the amount of dollars chasing products. But also, people will now have an incentive to save. As the Fed continues to hike rates, next hike on July 27th, then the 21st, we're going to get a Fed funds rate near 3%. And that means you can get savings in the bank of 4% or so. So maybe I wasn't interested in putting my money in the bank at 1/10 of 1%, but at 4%, I might put some money away. So what's inflation? Too many dollars chasing too few products. This is money coming out, so less dollars. So what the Fed's trying to do is cause demand destruction, slow things down. And that should help mortgage rates as we get into the fourth quarter. I think, Dale, we could get back under 5% between the fourth quarter and first quarter. And listen, Dale, you know this, rates in the mid-4s, we can kick butt with that. Now, we know that there's going to be a recession. We've called it, as I mentioned a while ago. We are very convinced. Look at what the Fed does every time. Let's go back 80 years. Fed starts hiking, it brings us to the darker era recession. Again. Every time. It didn't happen here after the Fed rate hikes, but that's because we had the advent of the internet. And the last time it occurred, and here's where we are now, we're going to be hiked right into another recession. The Fed will never admit it. But if you look and read between the tea leaves here at what the Atlanta Fed and the Cleveland Fed are saying, they're forecasting gross domestic product for the second quarter to be roughly at 0. And this is after the first quarter was negative 1.6. They'll never forecast a negative number. So it wouldn't surprise me to see a negative print for the second quarter. Now, the definition of a recession comes from the National Board of Economic Research. They're like the umpire. You know, the rule of thumb is 2 consecutive quarters of a GDP print that's negative and you're in a recession. But it's not official until they call it. But you know what? The analogy I like is this one, Dale. 2 quarters of GDP negative is like a pitcher throwing a ball right in the heart of the plate, dead center. It's pretty hard for the umpire not to call that one a strike. So we have to wait for the National Board of Economic Research to call it, but I think they'll call it a recession. And then the argument against that you hear all the time is the job market's too strong. Job market. How could you have a recession when the unemployment rate's so low? It's only 3.6%. Well, here's the news flash. That's exactly when you get it. You never get recessions when unemployment is high. You get them when they reach their lowest level and begin to turn higher. Let's look over the last 100 years, and this is a 100% accurate correlation, no deviations from it. Every time the unemployment rate reaches its lowest level and starts to turn higher, you get a recession right around the corner. Here's where we are right now, 3.6% unemployment rate. When we get the unemployment numbers, watch for a couple of months where it starts to tick higher. You will know that recession is right around the corner. So here's the payoff. What does this mean to us? Well, here's what it means to us, Dale. It means that mortgage rates during recessions decline. The last one, they dropped 1%. Here they dropped 1 1/8, near 1%, 2.25%, 5%, 4.25%. So mortgage rates decline. And then the other big question, because the media is going to say, okay, you got a recession. What's that mean for real estate? Well, let's look at the facts. During the past 9 recessions, real estate values went up and up a lot more after the recession. One exception, and Dale, we remember this. This was, the housing bubble that led us into the recession, not the recession that caused the housing bubble. The housing bubble, 100 LTV, no income, no asset, investor loan, 580 FICO, no job. I mean, kind of crazy situations there. Plus demographics were different. And before I go to the next one, Dale, that was a lot of stuff there. So let's just take a pause here, and then we can go and talk a little bit about housing.
Well, thanks for sharing all that data. I think that helps an awful lot of people to understand a little bit better exactly, how the market works, what drives the market. Because you're right, people think Fed rate goes up, rates are going to go up, but that's not the correlation. You've got to look at.
Hey there, audio listener. Producer Jake here. Thanks so much for listening to the public version of this episode featuring the founder and CEO of MBS Highway, best-selling author of Money in the Streets, which is available on Amazon, and 3-time Zillow and Pulsenomics Crystal Ball Award winner, Barry Habib. Look, Barry's a legend in this industry. Not only is MBS Highway a leading solution in the space, but Barry has imprinted his influence on a number of the industry's latest events and conferences. He's a frequent guest on radio, TV, and of course, podcasts. He's even one of the co-founders of Social Survey. Needless to say, you want to hear what Barry has to say. So here's what I need you to do. To listen to the full episode, just visit dalevermillion.com/Diamond Club to join a members-only club that has exclusive access to the full-length conversations Dale hosts with incredible guests like Barry. As a member, you'll not only get your own personalized feed to listen to Batting 1,000 in your favorite podcasting app, but you also get access to the full video interview, plus getting access to transcripts, blog posts, and more. Become a Diamond Club member today by visiting dalevermillion.com/Diamond Club. One last night before we go today, Barry and his team are graciously offering a discount to Batting 1,000 listeners. You can save 40%. You heard me right, 40% by just using the code EVENT, that's EVENT, EVENT, when checking out at mbshighway.com. With that code, that's just $120 a month or $1,200 a year for access to a leading technology, daily videos, and everything that the MBS Highway team provides their user base. Our thanks again to Barry and the team for this special offer for you, our listeners.